Good morning, good afternoon, and good evening. Fitzpatrick Kapepe, who will actually be taking you through the analysis on AEL Mining. I received the financials as published on 5th March 2021, and I thought it fit that we should maybe just go through and check on how AEL is actually performing. This is an independent analysis. And in some instances where we could not find the data, we used assumptions. So today we'll straight away go to the extractive industry. Yesterday we looked at Zambru. So it's just from alcohol to explosives. So our first analysis was on Zambru, and I must hasten to thank all my LinkedIn connections for the positive feedback I received. And this is what has just encouraged me to take it as not really as a hobby, but as part of my works to be doing this analysis each time I receive the financial reports. But in the meantime, I'll restrict myself to companies that are listed on the Lusaka Stock Exchange. Okay, start. So this is the income statement, slide on the income statement. As at 1st December 2020, you can see all the revenues going up. Even the earnings per share has actually gone up from 3.49, 5.47. Obviously, we should actually appreciate one thing, that AEL sells in dollars. Most of their sales are in dollars, predominantly in dollars. With the depreciation of the kwacha, it is not strange to see the revenues going up like that. The balance sheet has also grown in terms of the assets. You can see from 59 to 123. What is interesting, again, is that AEL Mining, this particular company, is not very geared. You can see the levels of the non-current liabilities, which is actually sitting on their balance sheet, meaning that their balance sheet is still a bit strong. Yeah, this is where we have the cash flow and the statement of changes in equity, which we call as SOCI. So again, when you look at the cash flow statement, it does actually give you an understanding that the investing activities could have been purely funded from equity, from the operating activities. But what is not so clear, and in my analysis, I'll slightly go into details. What is not clear is on the financing activities, which are negatives there, yet their non-current liabilities are quite very low. So the question is, what are those activities that are under the financing activities that are under that particular category? These are abridged financial statements or reports. I think for this report it was not more than 3 pages as well. So there wasn't so much data that I could actually use. So where I could not find the data, I was using some assumptions, but educated assumptions. So let's now go into the analysis. After looking at just after this presentation in PowerPoint, we'll go to my Excel just to show you how I was doing those computations, how I was calculating CAGR and many other metrics. So brought in the financials for 4 years from 2017 to 2020. So you can see from 2017 to 2019, they are all actual. Then calculated the CAGR, that is compounding annual growth rate from 2017 to 2019. For those that are in love with Excel, I was using a function called RRI, which I'll demonstrate the other side. So with all these income statement elements, what stands out is revenue, which has actually been growing at 12%. But then I wanted to compare to see whether the 2020 actuals were affected by COVID. So did the computations forecasted 2020 using the 2017-2019 CAGR to see where 2020 financials or income statement elements should have been using the growth rate from 2017 to 2019. So it does show you that the forecast for 2020 from 2019 at a revenue of 655, it should have actually gone to about 735. But luckily, it went to 798. Obviously, there are issues of FX and all that. So in this case, the revenue grew at 8.6%. That is if you're comparing, the variance, if you're comparing the actual 2020 against the forecast, you find that the variance was just about 8.6%. The rest, they were around 50%. But then it actually shows you that with the forecast, we should have had our earnings per share, or they should have had the earnings per share around 3.56, yet the actuals gave out 5.47. And equity shares was growing at about, I think, 0.045%. Small margin, so to say. So looking at the numbers, I would comfortably say this organization, it was doing fine, at least it did okay. If you have to compare with the forecast, but also there are issues of the FX movements, which have somehow dilute this analysis. So if you have investors, obviously they'll be interested to see the future. So I thought I should bring in the future, and that's what I brought in. I thought I should have brought in the future, and that is what I brought in. Showing the revenues, they will grow, but then now change the CAGR from 2017 to 2020 to 2019 and used 2017 to 2020. So I had to bring in the actual 2020 to compute CAGR, and those are the numbers that we have now. So you can see how revenue will be growing at that compounding annual growth rate. Then earnings per share, we expect that in 2021, the earnings per share could actually be around 6.44, going up to 2023 at 8.93. So this is what you expect in terms of the revenue. If you are an investor, you would be interested in actually seeing how the revenue would actually move into you. Just giving you an understanding or some comfort, levels of comfort that your investment is still viable. So we expect that revenue to grow at that level. That is on the condition that FX remains as is, and other variables like inflation and all that, they remain as is. Then we expect that the revenues will grow like that. We'll be growing at 15%. So this is basically the basis at which I've used the forecast. So the forecast was actually hinged on the CAGR 2017 to 2020, and it does actually show here that the highest is retained profit attributable to shareholders and earnings per share, which is at 18%, and the lowest will be the revenue at 15%. So income tax is expected to grow to 16%, profit before income tax 17%. So these numbers, they are almost within range. The financial metrics, it was very difficult to extract certain data. So you had to do a lot of reverse engineering in getting this information, because what AEL did, their financials, their abridged financials, are even more condensed or abridged than Zambro. Zambia breweries, it was easy to see the cost of sales. It was easy to compute the working capital, that is the inventory days, the trade receivables days, payables days. It was very, very easy. With this one, it was very difficult in coming up with all these numbers. So the numbers that you see in blue, those are the ones that I've used reverse engineering in determining them. So you can see the dividends, the dividends line. Strangely, in 2020, the dividends that were actually given to us more than 90% of what was actually given in 2019, or what was actually paid in 2019. And when you look at the levels of EBITDA, or dividends as a percentage of EBITDA, from 2017 to 2019, it was just on the average of around 50s, maybe 52, 53. But in 2020, for some reason, the investors, in such a very awkward year, they were actually given more dividends as a percentage of EBITDA. With that EBITDA of about 144 million, if the dividends were actually given at 50% or 52% of EBITDA, we would have expected the investors to receive about 75 million kwacha in dividends. Then there's something that is so interesting. When you look at the cash flow from financing activities, you can see there that is negative, meaning that this company is actually not getting any loans. But then if you go to the balance sheet, you see that even the numbers on the balance sheet, they are extremely low. Where? On the non-current liabilities. In 2019, it was 15. In 2020, it was 30.7 million. Yet, they had cash outflows from financing activities to the range of 50 million in 2019 and 107, or should I say 108 million in 2020. So the question is, where was this money coming from? What were they paying? If they are not paying for long-term debt, what were they paying? Actually, I've even put the numbers there on the non-current liabilities. We are able to see the numbers. But then, when you look at these numbers on the cash flows from financing activities against the dividends, you see that there is a very close correlation. And the dividends paid could come from two areas, depending on where you want to put it in your cash flow. It's either you put it under operating activities or under financing activities. That is the only dividends paid. Dividends received, because this is part of your investment, so you expect that it's actually going to sit under investing activities. So we had the cash in there. Quick ratio is still very high, though it is actually regressing a bit, but it's still high. Over 2, it's very high. The asset turnover, going to 2020, actually from 2019 to 2020, you can see that the asset turnover is actually regressing. This simply tells us that this company is actually not efficiently using its assets to generate revenue in 2019 to 2020 as compared to 2017, 2018. In 2020, maybe you would actually say, because you'd actually say that in 2020, they had introduced new assets, new fixed assets. So it is just normal when you introduce new things, you might not actually realize your revenues, or you might not fully utilize your machinery to actually generate meaningful revenues for you. But we are able to see that there's asset turnover. The numbers are actually going down. A bit scary, but it's still okay. In terms of these numbers are still very, very okay. But it's still a worry that we're actually seeing them going downwards. So this is that's on acid test ratio, which you call as quick ratio. Industry standard, you'd find it to be maybe 1:1 or slightly below that. So this is still very good. These are the lowlights, like I was saying, on the financing activities. Yeah, we are seeing that financing activities, the cash outflow from financing activities is almost equal to the dividends. What was happening here? Was this company supposed to pay dividends? If it was supposed to pay dividends, it should have been how much? But then, when you check on the working capital is actually growing I can bet you on this one that the trade payables might also not be, maybe they're not being paid adequately. When you see how this working capital is actually growing, like in 2020, it went to 517 from 373. I think that is very high. Because what is the funds coming from the operating activities, they're just enough to pay for capital investments. And this is where, if I come here, you'll be able to see it. So you can see, like in 2020, the cash utilized in operating activities, the net operating cash was 53,168 million or 53 million, against the cash flow from investing activities, which was 51, so that somehow it cancels. But there's still financing activities of 107 negative. The question is, where is it coming from? What are they funding, which the balance sheet cannot show? So this is on dividends versus cash flow financing activities. I don't know really what was happening, but this cannot be coincidental. It can't be coincidental, sorry. I don't know. So thank you so much. But let me just go to my Excel. If you need my model, the Excel, the one that I was using in developing all these charts and the analysis, you can freely send me a text or an email or a message. I'll be able to send that. So let me go to these are the numbers. So on Kaga, I was using a function called RRI. If you want, you can still use Excel as the function called power. It's a bit complex than this. This one is pretty easy. You can still adopt this to calculate your compounded annual growth rates. This is where we have the actuals against the forecast, then the variances, just a micro chart the other side, and picking from 2020 and growing it at the Kaga levels for 2017 to 2020. And you have this chart that is in the presentation. I was using error bars in coming up with these charts. You can visit my YouTube account and you'll be able to see how these charts are developed. So thank you so much. See you next time. Thank you and bye-bye.